The UK budget has just dropped, and well, the headlines tell you that they won't be raising tax on the three main taxes of VAT, income tax, and national insurance. But this means they'll be quietly pulling you into higher tax thresholds for the next 3 years. Throughout this video, I'll be breaking down the main financial points and making them in simple terms for you. Just quickly, if you're new here, hi, I'm George. I'm a data analyst at the top Fortune 500 company. And if you really do like finance videos, please make sure to hit the subscribe. Now, firstly, no big tax changes. Your income tax, your national insurance, and VAT is not going to be increasing. Now, on paper, this sounds really good. And to a certain extent, it is. At least the income tax isn't going up. But this is frozen until the year 2028. So if we look at the data, we can see that there is going to be hundreds of thousands of people in the next 3 years being dragged into the basic, higher and additional rate taxpayers. This effectively acts as a stealth tax over the next 3 years on your paycheck, whereas the tax rate should be moving with inflation. We're living in such a completely different time now to when those tax rates and brackets were put in place. It was so long ago. They need to be increasing with the times just because UK salaries have gone up drastically in the last 5 years. And the current tax brackets that we have are no longer fit for purpose. So for the next 3 years, each and every time you're in whichever job you're in and you get a nice little pay rise at the end of the year, potentially you're in a job that gets a bonus, you are going to be taxed each and every time on that. And although it is the same amount of tax that you've been paying for many years already, this will be a stealth tax coming from your paycheck. And this is called fiscal drag. You may have heard it from other YouTubers in the media, in the headlines, but effectively it means that as you progress, you get a better job, you get a better salary, and you're trying to progress and be a better person in this world, you are going to be taxed at the same rate as you was 5 or 6 years ago. Whereas the tax bands and brackets should be following the rate in which that people are growing, or at least the rate of inflation. Now let's jump on to the next point of the £2,000 cap salary sacrifice. Now, if you don't know what this predominantly benefits people within the corporate world and potentially even people who own their own company. So what salary sacrifice is your pre-tax salary. You're able to take money from this pre-tax salary that your employer gives you before it's had the government take its 20 or 40% tax away from it. What this means is that you get a higher amount of money that you can put into things like your pension, potentially your workplace car scheme. There might be a workplace loan scheme or travel scheme, travel to work, and you can use your pre-tax salary in order to pay for this so that it is not taxed first and then paying for it after. It's a very efficient way to use your salary if you've got the means to not need it right now. I personally use the salary sacrifice to add more money to my pension. I don't necessarily utilize the car scheme or any of the other schemes that they use, but I think that when a bonus comes my way, I automatically put a lot of it into the pension scheme. Now, the way that the Chancellor has framed this is that the big city bankers are getting these huge bonuses, of 20, 50, 100, £500,000, which is completely true. Many people, it's not just within the financial sector that people get large bonuses. In almost every sector within the corporate world, many people get large bonuses. The financial sector is just picked on because the particularly high number in which they get. Now, many of those people, you can take that bonus to cash, you can take it to your salary, but of course you're going to be paying a certain level of tax on it. Or even if you take a deferred payment, you're still going to be paying tax, but it may be less. But what many bankers do, and what many people in the financial and whichever sector it is that take their bonus, is that instead of taking it for themselves today to spend, they will put it through the salary sacrifice scheme and put it straight into their pension. What this means now is that they are only capped to £2,000, which in the grand scheme of things, and if you look at the very broad range of jobs that is out there, not just the financial sector getting these very large bonuses, £2,000 is really not a lot to be adding to your pension as a pre-tax salary. Now, it's made out to be that the higher earners, the top 1%, the top 5% of earners in London, in the UK, are going to be getting penalized for this, and they are going to be getting the most revenue. But I would argue that this is not just going to be hitting the top rate of high earners. This is going to be hitting the middle class and even the people who are just jumping into the corporate world, potentially after university or during their apprenticeship. They're going to be getting penalized at a £2,000 cap just because one side of the aisle is earning more than the other. Personally, I think that £2,000 is just far, far too low. Now, bearing in mind, this change is going to be coming in 2029. So whether this does actually go ahead, I'm not too sure. However, £2,000 is extremely low. And I think that if they really wanted to put a cap on, they should have capped it at, somewhere in the range of 10 to £20,000 rather than two, because it backs people into a corner, and it backs people into a corner of paying more tax when they're just trying to invest for their future. The predominant people who are using salary sacrifice is for the pension scheme. Let's jump on to the next point, and this is one of the most crucial ones, is the cash ISA allowance reduction. So this has gone from £20,000 to £12,000. And what Rachel Reeves believes that this is going to do is that the £8,000 that many of the savers would have been putting into their cash ISA, they would like that to go into the stocks and shares ISA and try and invest into the stock market, particularly the UK stock market or potentially the US stock market, but to try and get that money flowing, because there is a large amount that is just sitting in cash ISAs. Now, I can kind of understand the vision and the plan with this, that yes, there's going to be less money in the cash ISA. And if you are doing particularly well in your job, or you're wealthy enough to be able to put the £20,000 cash ISA in, straight away, effectively in April, that you're now going to have £8,000 less, and you're going to be thinking, what should I do with that 8,000? Right, let me put it into the stocks and shares ISA potentially. Now, this might be the case for a very small number of people, but if we look at the statistics of how many people actually have ISAs in general, it's only about 8% of the population. It's very, very small. And the majority of them are holding it in cash ISAs. The people who actually invest into a stocks and shares ISA is a very, very small percentage of the overall population. Now, what this tells me and what this tells everyone is that people are very, very scared to actually invest into the stock market. It can seem like a very daunting thing, especially if you're not necessarily just starting out as an 18-year-old. Maybe you've got £1,000 or you've got £500, spare money that you've earned, and you're going to just throw it into the stock market. It's very low risk. But if you're talking about some of these people who are potentially in their mid 30s, getting on for 40, they've never invested in their whole life. And they may potentially have 50, 60, 70,000 pounds that is saved up in the bank account that is just sitting there, or potentially in the cash ISA. Even at my workplace, some of the people that I've spoken to who are around that age, they have no clue, they don't know anything about investing, and the main thing is that they are scared. So what this is going to do instead is, instead of people actually going out of their way to put the £8,000 into the stock market because they're too afraid to do so anyway, they're more than likely going to be putting it into bank accounts, or banks are going to be pushing them their terrible investment advice, and then effectively being taxed over their personal allowance, which is just not really that fair. And this is again just another stealth tax. Now, I also want to make the point that the cash ISA has gone down from 20,000 to 12,000. It's a complete step in the opposite direction. We're in a completely different time to when these rules were set out, and that these cash ISA and the ISA limit in general should be continuing to go up with inflation rather than staying stagnant or going down. I watched Damien Talks Money video, and I really liked the thing that he said is that you need a carrot, not the stick, in that it feels like people are just getting hit with the stick rather than using a carrot in order to help them invest. You're being hit with the stick that you shouldn't put another £8,000 into your cash ISA, rather than being actually taught and educated how to invest and keeping that ISA allowance at 20,000. Now, I only mention this because now the cash ISA limit has gone down. What does this mean for the future? Does this mean that there is potential to reduce the stocks and shares ISA limit in the future? Is there potential to reduce the LISA limit, which is already at only £4,000? What is next? This has already been passed. I personally don't utilize the cash ISA, and I utilize the stocks and shares ISA, so this doesn't massively affect myself. But I'm thinking for the future, if they're going to be reducing this today, who knows if they're going to be reducing the stocks and shares ISA? And if that does happen, it's going to be a very, very sad day for investors. Let's jump on to the next point of a mansion tax introduced. So properties worth £2 to £2.5 million will pay an extra £2,500 in council tax, and up to £7,500 for any properties that are worth 5 million or over. Now, of course, this is going to be predominantly hitting the people in London, the southeast, potentially some of the really nice homes on the outskirts of Liverpool and Manchester. But the percentages in which that they have calculated this doesn't really make sense. And credit to Damien Talks Money for this point, because I've taken it straight from his video. But it actually costs less to own a £5 million+ home than it does to own a £2 million+ home in council tax. If you look at the percentages in how much you're paying for the £2 million home versus the £5 million home, it's actually more economical to just pay the council tax on the £5 to £10 million home than it is for the 2 million. And yes, you could say boo-hoo to the person who's paying an extra £7,500 per year in council tax for their 5, 10, £20 million mansion. But I have a slight suspicion that all this is going to do is, first of all, slow the housing market, especially the high-end housing market. And I'd probably say that some of the luxury houses here in Chelsea that are costing 2 million, maybe 2.5 million, they're probably going to be selling for 1.95 million now, just in order to curb and not pay that council tax. I don't know, I'm a bit mixed on this one. I don't really have a huge opinion on this one, but potentially you could raise the council tax just slightly on the houses that are 50 million and above rather than just 2 million. Because if you look at some of the houses here in London today, some of these regular 2-3 bedroom houses are going for 1 million already. And I'm not saying that's in every single area, but if we just look at how much houses have gone up in the last few years, who's to say that a £2 million house isn't going to be common ground in 10 years? Maybe not 10 years, but 15 or 20 years. Now let's go on to the next point, in which that Rachel Reeves didn't actually say this in the speech. This was kind of snuck in after and released on the government website. This is now that Uber and Bolt will be paying the full 20% VAT on the full ride amount, not just the profit that is made on it. Now you might be thinking, yeah, so what? Shouldn't big companies be paying the full VAT on the full fare, not just the profit? Well, I only bring this up, whichever side of the aisle you're on, whether to tax them more or tax them less. But what this means is that yours and mine, whenever you want to take an Uber or a Bolt, is going to be going up in price. It probably won't happen immediately, and the price probably won't go up a full 20%. But I would imagine in order to keep the same steady profit margins that Uber have been doing, they're probably going to be wanting to raise the price maybe 5-10%. I don't know. But all this means is that fares will be increasing, Uber drivers' earnings will probably be less, and they've nicknamed it the taxi tax. And this brings me over to the next point of the 2% dividends tax increase. So at the moment, the dividend income tax is 8.75%, and it's going to be jumping to 10.75%. Now, this could mean two things for you. Is that if you have any money invested in a general investment account that is outside the stocks and shares ISA, and you receive dividend income on that, you're going to be paying an extra 2% on every single dividend payment that you receive. And this is if you're a basic rate taxpayer. If you're a higher rate taxpayer, it's going to be jumping to 35.75% dividend tax, but the additional rate taxpayers will remain at 39%. And then the second way that this could impact you is that if you are a director of your own company, and one of the main ways in which that you take your income is through a dividend payment, maybe a few dividend payments per year. Effectively, your salary that you're getting to pay for your everyday life is going to be taxed an extra 2%. A very common way in which that business owners get paid is that they have a company, they are the director of it, and instead of getting paid through salary because you are taxed at the basic, higher and additional rate tax pays, especially if your company's done very, very well, then you're going to be wanting to see some of the fruits of the labor. Well, instead of doing that, you can pay yourself under the basic rate taxpayer, and then instead of paying yourself a regular salary like a monthly, you can pay yourself a one-time dividend or a few dividends throughout the year. And instead of being taxed at 20 or 40%, you'll only be taxed at currently 8.75%. It's a very tax efficient way of getting paid through a company, but what that means is the people who are currently using that method will be getting taxed an extra 2%. And then the last point is the national wage increase. From April, the national living wage will be going up 4.1% to £12.75 per hour. For 18 to 20-year-olds, it will be going to £10.85 per hour. And for minimum wage 16 to 17-year-old apprentices, it will be jumping to £8 per hour. Now, I'm a bit mixed on this one because for the minimum wage workers and the lower earning workers, it means that their pay and their salary is going to be going up. It won't be going up by a huge amount, but it will be going up either way. However, I think for some small businesses, this is going to really impact them once again, because many of them can just about pay what they're paying to their employees already. But the way that I see it is that every single country I travel to, I try to see and gauge how much is the average daily salary and how much is the average hourly salary. Because when you figure out these two things and take a look at the GDP of the country you're going to, you can roughly figure out how much money you're going to be spending in that country. Believe it or not, but all of the regular everyday stuff that you're buying on a day-to-day basis, especially within the retail space, it is all drastically impacted by how much the average hourly salary may be, or in our case in the UK, we have a minimum salary. And everything that you buy is massively impacted by how much that minimum wage is. Because that's the thing that contributes the biggest percentage to the percentage increases in all of the stuff that you buy, whether that be in the clothes shop, whether that be in Greg's, you're getting your daily lunch or you're getting a nice dinner. How much that person earns who is serving you per hour dictates the price of what you're going to be buying. And therefore, whenever the national living wage goes up, the prices of everything else goes up as well, because all of these companies are not just going to be taking the hit of increasing the living wage. They have to do it mandatory. They have to put the prices up for, they have to put their employees' salaries up, and therefore they then put the prices of absolutely everything up in their shop. So in this case, I'm not really for or against putting up the national living wage, as it's a bit of a double-edged sword. Is there'll be many people who will benefit from this increase going up, both the minimum wage workers and also the government, because they get to take an extra 20% from your increase. But then that means everyone else in society, even the people who are on minimum wage, trying to buy stuff and spend in their daily lives, are going to be spending all of that money that they're earning extra anyway, because the prices of everything has gone up in order to satisfy the national living wage. So I'm not really for or against on this one. It's a very, very tricky one to really get a final thought on. And then just very, very lastly, to add a little bonus, is that rail fares have been frozen, and between major cities, off-peak and peak fares will remain the same. I don't know how long this is for, but probably for the next year or two. If you really did like that video, please make sure to hit the subscribe button and also give it a like. YouTube recommends you watch this video here, so go ahead and give it a watch. Thanks, and I'll catch you in the next one.